right, well, g'day there, everybody. Thanks a lot for taking the time to click on this YouTube market update. I know it is predominantly associated and really applicable to that of the US financial markets. However, in the context of where we are, given the bounce that we have seen in the S&P 500, the NASDAQ, the Dow Jones Industrial Average, and really broader markets around the world, I do think that as I sit down and bring you this special recording, as at the 2nd of May, right, Saturday the 2nd of May, I think in retrospect, in the months to follow, this is going to be some form of a timestamp whereby the markets themselves were gifting you an incredible opportunity to, one, shore up or take risk off on any long trades that you may be holding, to shore up some of your portfolio, and also for those who are a little bit more aggressive to actually take a net negative position in the markets, more or less at market value, as at the close on Friday. But we'll see what happens over the coming weeks, whether or not we do see a dip. I am sure that we are going to see one final last dip buying mentality flow back into the markets, upon which I think that is more or less going to be it for the equity markets, globally speaking, around the world, until we do see this macro top really become quite clear to the masses who do follow as intricately as what I speak about in terms of the markets. But to more of an extent anyway, for people who don't follow the markets as closely as what we do. We've got some really brilliant technical signals and also economic metrics that are historically as accurate as what you can get. And again, a lot of what this weekend video is going to be about is more so the psychology involved in what's going on in what has been about a 1.5 month bounce. You can see a lot of complacency out there. Again, people are trying to restore the narrative of what it once was back in the months of January and February. And what I can say right now is that this period in time, this location on the chart is extremely similar to people and to a more recent time in history back in the period of January and February of this year, which I understand it feels like an eternity ago, even though it was really only 3 months ago. I can see some very interesting parallels about people essentially putting risk on at exactly the wrong time. And unfortunately for those people, they are going to be in for a world of hurt once we see this critical area up here hold and see prices, begin to trickle off again. I just wanted to point out that, again, a lot of what I say, not necessarily a lot of what I say, but I'm just going to tell you it how it is. It's what I've always done, and I understand there are going to be some people who obviously disagree with my point of view. And that's fine. That's expected, obviously. But if you are going to write comments below, please just, don't make it personal or anything like that. Just, give me your analysis, so to speak, on the technical side and also the fundamental side as to why you think these markets are going to move higher. But I don't think it really helps anyone whatsoever if you're going to be a little bit smart about it at all. I'd encourage you really just to turn this video off and, go watch something else if that's what you want to do. I'd encourage, obviously, comments. I read every single comment that is posted below these videos, but I'm just going to map out what's underway, what to expect, and what to look for moving forward. The inflection point, if you see certain things, well, the jig is up. The game is over, so to speak, and we're moving into that of a macro, right, primary bearish trend. I think that's really the transition that is going on at this particular time. People keep talking about the 30% rise off from the 2250 area on the S&P 500. But again, it's all about context. It's all about perspective. It was only really 2 months ago where the S&P 500 was trading up closer to 3,400 points. And the best it can really do at this particular point is to trade at 2,830 points. So we're still a long ways away from more recently the all-time highs in the month of February. And really what I want you to understand more so than anything is the psychology, which is really driving the particular movements that we have seen in the market over the past 1.5 months, but more so just really encapsulating that of the 2020 calendar year so far. I wanted to wake you up and to wake people up on this YouTube channel just to revisit, of course, more recently, the all-time high that we've seen in the markets. I just wanted to point out that the markets themselves, right, they're not going back to that more recent all-time high, and it's probably not going to get back there for a number of years into the future. Right, this is a carrot which is not going to be revisited in the year 2020. It's not going to be revisited in the year 2021. It will not be revisited in the year 2022. We'll see whether or not it is actually taken out in the decade of the 20s. It may not. It may very well happen. But at this particular point, I think the price action that we've just retested and revisited as at Wednesday more recently may be well and truly the best price that you're going to see on the S&P 500 for a number of years into the future. Just wanted to rewind into the narrative. Again, there's always a narrative driving the markets, but once the music stops, again, you see people tend to panic. And that's exactly what we saw in the month of March. Yes, this was brought forward, obviously COVID-19 induced, but the structural damage, so to speak, it's already been done to the markets. Whether or not this is all taken care of over the coming months, or whether it prolongs around for a number of years into the future, the damage is already done technically to the markets. And again, we're ushering in that of a macro, right, contraction, not only in the US, but also globally speaking. I don't gain whatsoever any pleasure talking about the markets through this perspective. However, again, cycles in the business cycle, the economic cycle, and of course, again, in this particular instance, the contraction that we are going to see for a prolonged period of time in equity prices, it just comes with the territory of markets themselves. So don't think that this is going to remain the way it is forever. I see this playing out more so through to say 2022, 2023. But as such right now, right, a lot of people, again, are being rather complacent about the most recent sort of bounce off from the structural lows of March 23rd, right? During the meltdown over here, right, people were frantically taking risk off, right? Frantically taking risk off. And it turned into, right, a very dangerous market very suddenly. A lot of people during, right, this drawdown were saying to themselves, I can imagine, that they've made a huge mistake and that they would never do it again, i.e. they had too much risk on the table as the markets were, again, cruising up towards 3,400 on the S&P 500 until everything changed. And I say this publicly again, that a lot of people probably made the promise that they wouldn't repeat such mistakes. Very quickly enough from the March 23rd lows, right, the sentiment or the psychology of investors and traders alike has shifted. And it shifted into, right, a narrative of now it's, oh my God, I've missed the boat. I've missed the train's left the station. I need to jump on in and buy. So the sentiment itself during the contraction was that this is the end of the world. And very quickly in the space of 1.5 months, there's a boatload of people now revisiting and making the same mistakes that were made towards the end of the cycle back up, right, in late 2019, very early on, right, in the first 2 months of 2020 until the music stopped. Publicly, again, you can go back on this YouTube channel, and we were jumping out of this market over here at 3,175 points. That was my personal target, and that was leading into Christmas. Okay, so pretty much we took all of the risk off over here, and we sat on our hands. Didn't do anything for the first 1.5 months of 2020. And then, of course, this major correction occurred. All right, there's a lot of people right now jumping back into the market with tunnel vision, expecting that the narrative that was once in existence over here is going to somehow magically, right, continue to draw equity prices back on up to revisit, maybe take out and continue above the more recent all-time highs in February of 2020. I'm here to tell you that, sorry to rain on your parade, but that's not going to happen. There's no chance whatsoever that the S&P 500 is coming anywhere close to 3,400 points, nor is it taking out this past all-time high that we priced in the month of February. There's a very good chance that we have now priced in the first macro lower high, or again, as I just alluded to a little bit earlier, we may see the first major pullback, which again, I've no doubt that there'll be a bunch of dip buyers jumping back on in to load back on up into equities, which may drive the equity markets back on up to create some form of a double top. But depending on how this week plays out, if we do see a little pullback, this is what will mark what will in a number of weeks into the future be some form of a neckline on equity prices. Right? It'll turn out to be a neckline in equity prices. I want to also just say that these bounces here, especially in bear markets or into a very fresh and new bear market before really the majority of people, or the average ordinary person has woken up to that of a structural bear market, right? It's here to draw people into the market. It's here to sort of work as a honeypot and to tempt people back into equities, right? To buy. And that's really fundamentally what a bear market rally is designed to do. And we are very clearly in that bear market rally, that clearing rally, that relief rally, which is ultimately going to fail, ultimately going to fizzle. And then as people were loading up like they were, right, leading into 2020 and into the first couple of months of 2020, again, the overhead supply, with a bunch of people at the same time taking positions off once this really starts to reverse, is really going to expedite itself and work up on itself once we crack below the neckline of this market moving forward. Everyone is trying to, at this point, to restore the narrative that once was, right? That narrative is not being restored. It's not coming back. We're not going back to make a fresh 2020 high. But I just wanted to point out that this is acting as a honeypot. I don't want you to fall into the trap of buying into this equity market at this particular time. If you've missed the boat at March 23rd, you've missed the first clearing rally of, unfortunately, this 2020 bear market and structural recession that we've now formally entered into. And this is probably very close to the best price that you're going to get from an investment standpoint, in my opinion, and also from a trading standpoint for anyone who is still looking at this market with rosy glasses. Again, the S&P peaked out close to 3,400 points. We haven't even retested 3,000, so we're still easily, right, over 10% away. Even if we were marked up at 3,000 points, we're back down at 2,830 very suddenly. I assume we are going to price in some form of a double top right at this location here, and that's going to lead to the critical break of the neckline, which is going to usher in, again, a major lower low. Now, if you haven't already put the pieces together, as I just sit down and speak to you about this, not only do I think that we are, again, going to come back to close this window here at 2,550, or this window, which may seem like a long way away at 2,325 points, give or take. I think we are going to take this low out on March 23rd and go substantially lower. I don't think that there's any reason at this point as to why this isn't going to happen. A lot of people have completely discounted this and said, well, it's an impossibility that we're even going to come down to the March 23rd lows. Find myself in the minority, not only to say that this is going to happen, but we're also going to go substantially below this area at 2,250 over the coming months. It might sound crazy. We're up here at 2,830, but again, this is what bear market rallies, this is what they live for. And the reason I'm putting this video out on a Saturday, as at the 2nd of May, is to say don't fall for the trap. Don't buy into this relief rally. Don't trust this relief rally, because that's exactly what it is designed to do. People who thought, or at least had too much risk on again, were panicking over here. Now they've changed into, boy, I missed a great buying opportunity. They're loading up again. I'm seeing a lot of anecdotal evidence again, even down here in Australia, of people who haven't been interested in the market doing exactly just that at this particular time. I'm sure you do as well. And it's not going to end very well for these people, right? They've got no understanding of market rallies, of retracements, of bear markets. This is not going to end. It's not going to be a V bottom recovery. You're not going to see these markets break to new all-time highs in the year 2020. It may only happen beyond 2025, something to that extent. The valuations we're seeing, the contractions we're seeing, I've no doubt that we're going to break below 2,250 before the end of this year. All right, that's really what we're looking at this particular point. I'm just saying it because, hey, it'll be a timestamp as at the 2nd of May as I upload this video. And I'm using this as a warning for people who are listening to say jump on into that Pivot Point Pro analysis class. We've just actually recorded that. A couple of telltale signals at this particular point. Again, on the monthly charts, if I can take the annotations off the screens at this particular point, is, look, historically speaking, right, you want to look for the 10 across the 20, very close to a market peak after an event. We've had the event. You can see here, actually, you can't see it, the number of occasions that it has happened, but on 2 occasions now, the S&P 500 has come back on up into the, what appears to be anyway, a sideways moving 10 exponentially weighted monthly moving average. We found rejection, on 2 occasions. I assume we're going to get a third retest of this area on the daily time frame once we see the first sell-off and the dip buyers jump back on in to create the M, which will be the double top, which again is going to work like this on the monthly chart. But really what you want to pay attention to is the 10 crossing below the 20, and then ultimately you can see the neckline just here, which will be price action taking out that 2,000 that March 23rd low, depending on where this wick is, but it's going to go substantially lower as to where we were down here at, say, 2,200 on the S&P 500. If this does hold, and I assume it is going to hold and continue to hold, it will map up that of a historic right shoulder. You can see that line in the sand over here. You can also see it on a 3-weighted yearly average of the Russell 2000, which I think is pretty fascinating as well. I know April was a very dramatic month. It was one of the best months, I think, since 1989, which is great for the stock market. However, in context of where it's actually happening, it's not at the beginning of a new bull market. It's at the end of a dying bull market. In fact, and ushering in that of a structural bear market that we're sort of, already in the midst of, that unfortunately people just haven't at this point figured out at this time. If you go back and have a look at some of the relationships that we've seen in the past, you get these similar bounces. In fact, in 2008, you saw a 3-month advance. I know we've only been bordering on, say, 1.5 months at this particular time through to the beginning of May. But you see the relationship as soon as that 10 crosses the 20. And the last time we actually got this was, again, prior to the GFC. Get that same neckline, and then we see a really big contraction in asset prices. This is the dot-com bubble going back to 2000. It might even be best represented, so to speak, on the NASDAQ. But at this particular point, a lot of the damage was done. Again, you get the first wave. On the S&P 500, we got, say, a 35% correction. Again, if you look at this historically, the NASDAQ during this same phase, we got about a 4-month advance, which got very close to the highs again. But the narrative that was driving the bubble, again, back at the turn of the millennium, the status quo never returned, right? People were searching for it. They were reaching for it. Again, it's like the speculative sort of reach for yield out there around the world when it comes to assets in general. But it's at that exact point, or very close to it, where you see the definitive turn down, and then the reality starts to set into people, or for people who aren't following the technical clues as close as what we do. Now, again, what's very interesting about this is you can go all the way back to 1929. Again, I've been showing people this, which I think is rather fascinating too. If I can bring it up on my chart, just bear with me a second. It goes almost as far back as I possibly can bring data, at least on my trading activity. But generally what happens is the 10 and the 20 exponentially weighted moving averages on the monthly time frame, right? It's very close to the simple moving averages on, or at least the trailing smooth moving averages on the daily time frame. And again, if I just change this to a line chart, not to say that we're in for the future of what happened beyond the 29 crash and through to low in 32, but just to put this in perspective, yes, it did decline a little bit more. It got into sort of the low 40 territory of the actual initial crash. But again, even if you go back to the 1930s, what happens is price action, it generally revisits either the 100 or the 200 smooth moving average, depending on how big of a bubble you are in, right? Relevant to price and where those simple moving averages are positioned on the chart at that particular point. It's pretty fascinating because a lot of people, obviously, they weren't looking at charts back in the 1930s. However, price action, it gravitated where to? Right to the 200-day simple moving average, which created the first substantial macro lower high. And then, of course, if I can zoom on out and show you this, it took a long time, but that low, right, it was ultimately taken out. And then the real bear market sets in. So we are still in a point whereby the psychology itself, this rally here, people are expecting the narrative to return, which is very similar to the peak that we saw in January and February of 2020. But the reality is that it's not. And you have to be an early adopter. I know it's hard to do. And again, I'm not here to sort of upset anyone, but I just wanted to show you the actual risk of what beckons, so to speak, if you're not going to change, right, that initial viewpoint or standpoint on the markets at this particular point. There's a big shock that's been done. There's going to be consequences to that, and they're going to be lingering as well. But even if you speed this up and have a look at the relationship, this is the closing price. So again, you're not actually going to see the candles. Actually, I'll bring on the candles. We got very close to it as at Wednesday. We've pulled back a little bit on Thursday and Friday. Again, I'm still expecting to see another wave up to actually create that reversal top, but it's a very similar process. I mean, we're talking about a lot of data going back over a number of years. Okay, and again, if I just go back and show you this relationship at certain other macro transitional tops, whether it's the first wave down and the overshooting of it, or a larger first wave down, and then the retest of the 200 or the 100, right, depending on the market that you're following. It's the 200 on the S&P 500 in 08. you can say it follows a similar behavior. And the reason it follows a similar behavior is because at the end of the day, it's just humans transacting in the marketplace. There's a lot of people, again, jumping back into equities at exactly the wrong time, not truly understanding just the type of reversal that's set in motion at this particular point. We've already taken out, of course, the December 18 lows, right? This was leading into Christmas. Remember that. We got a very strong rally out of that area. Obviously, the Fed funds rate's been cut. It's effective at zero at this particular point. Really, all we have is continued fiscal and, again, monetary policy and Fed interaction in the market to help sustain this in terms of liquidity, but there's nowhere lower. I mean, yes, you can have negative interest rates, but that would be an absolute disaster for the financial system in the United States, again, for the broader world as well. All you need to do is look at Japan and also Europe as well. If you look at their financial sectors, have a look at some of those ETFs that encompass that. See what happens there. I don't think we are going to go negative in the United States, but the writing's on the wall anyway. And again, this is going to be something that maybe you go back and timestamp at some point. The 2nd of May, you come back and revisit this analysis here. You're seeing, again, the Fibonacci retracement areas. This is the Dow Jones Industrial Average. We've tagged more or less the 61.8 fib, got above the 50 momentarily. We're back down below it. If you have a look at the S&P 500, you've tagged, again, the 61.8% fib. You've got another very clear rejection off from this level. If we bring up the Russell 2000 again, you've hit the 50. Another rejection off from this. If I go out and also show you some of these divergences too, have a look at this. The Russell 2000, right? We're talking about more of the breadth of the market alone. You can see it made its high back in the year of 2018. It made its first lower high, very close to, dramatically very close to the end of 2019. It fitted into 2020. It was actually January where we started to see the real weakness. However, have a look at the divergences across the board here on the Russell 2000. Again, talking about a snapback rally that a lot of people are championing at this point. It's what it's designed to do, right? It's designed to draw you in, to be one of those unfortunate souls that simply jump on in buying and hoping for the best, where you're just going to get the reality, the wake-up call. It may not happen, obviously, this week. It may not happen in the month of May. It may not even happen in the month of June. But over time, you're going to see these longer-term simple moving averages, which are now bearishly aligned, price below all, right, making the first substantial lower high, about to project now into that third macro lower high, right? This is just a continuation. It's sort of a slow motion train crash in effect here on the Russell 2000 that I'm showing you. I've pointed out the divergences on the Russell 2000. Have a look at the Dow Jones Transportational Average as well. Obviously under extreme pressure, very, very similar to. You've seen that substantial lower high in 1920. You've taken out the low back in late 18, early 19 as well. You've broken below the decelerating fan lines. And now we're just trying to retest even that 0.382 Fibonacci retracement area over here on the decelerating fan line too. So, there's a lot of technical damage in this market. I know the NASDAQ is holding up the best, okay? And I haven't actually referenced this up until now. But again, we got above the 0.618 or the 61.8% retracement of the first wave of the sell-off. Everyone's jumping into tech stocks, obviously. Let's just name a few. If you've got Amazon, what happened? Came out with earnings recently. It was at an all-time high as recently as Thursday. What's happened? NASDAQ down, right, on Friday, $187. We'll see whether or not that has any legs to it. If you wanted to jump into Apple, Apple's doing everything in its power to close this open window. Shooting star candlestick on Friday, which is quite interesting as well. Even if you look at the weekly candles on the Dow Jones, you've got a shooting star candle there. You've got another shooting star candle on the S&P 500. On the NASDAQ, look at this. Another shooting star candle after a hangman candlestick over here. But what's interesting too about this is that if you jump back into, say, Microsoft and a lot of these other big tech companies, you could say that 5 stocks at this particular point, concentrated anyway, have a market cap the size of, I'd say, somewhere between 20 to 25% of the NASDAQ and also the S&P 500. Those stocks are Apple, they're Amazon, they're the Googles of the world, they're the Microsofts of the world, and I think it may be Facebook as well. Not 100% certain what that 5th share is, but those 4 stocks alone, the market cap of those is making up 25% at most of some of the market indices. And that's really the only thing holding up the NASDAQ at this particular point. If you start to see these big tech behemoths begin to turn down, you can see already the macro lower high, which is pretty much being priced in. If Apple makes it up to 309, fair game to it. But I don't think it's going to be taking out this all-time high. If this is a macro all-time high for Amazon that we've just done, That's going to be some significant weight on the NASDAQ moving forward. You can already see it in Microsoft as well. You can see there's leaning, right? Macro lower high at this particular point. Google, I mean, and by the way, just have a look at the volume readings on all of these tech companies. You not see the divergence there, just very simple, an exercise like this. Have a look at Microsoft. I mean, you can just see the distribution taking place in the face of, right, what people are assuming to be some form of a, another bull market continuation of a rally here, which is simply not the case. All right, so really, if there's one thing to think about right now, it's one, I mean, just to be level-headed about this, there's been a significant shift underway well before COVID-19. This is really, I believe, just really clarified, again, a lot of the underlying weakness that was slowly coming into play towards the end of 2020 and even very late into 2019 before we saw that substantial market rally, which again, we were positioned bullish on, right? You can go back and timestamp all of the analysis videos that I've put out in YouTube. But if you've listened so far through to what I've said, there's very clear obvious distinction between the optimism that we had in the calendar year of 2019 more recently, to us becoming very cautious up here at 3,175. We missed the absolute top. That's fine. You never get the absolute top. But right now, it's not me sitting here saying this is a fantastic time to buy the market. It's me on the opposite side of the trade saying this is a fantastic time to sell shorts or open put positions, or at least take risk off the table if you're holding a predominantly centered long portfolio at this particular point. Obviously, I can't tell you what to do, nor would I ever. However, I can speak for myself. And in retrospect, I think this is going to turn out to be one of those opportunities whereby, again, a lot of people who promised themselves that they wouldn't repeat the same mistakes like they did the back end of 19 into early 20 are doing exactly that 1 quarter later right now. They're saying to themselves, we've missed the boat. This is the best time, right, to buy the market, to get on in. It's already trading at a 30% discount now, probably closer to a 15% discount as to where it has been more recently. But this is where you're going to see, again, it drift lower, lower, and lower and take out these swing lows over here. So, I mean, I don't want to scare anyone or confront anyone, but there's a very, how do I point this out? If I had to take a punt as to whether or not the market would get above an all-time high or below this more recent macro low, I'm certainly in the band or in the camp of this over here, the March 23rd low. A much higher probability that this is going to be taken out, right? We're going to go below this. And again, the S&P 500, to put this in context, by the time there is a bottom, the S&P won't be trading in the twos. It'll be in the ones somewhere, probably closer to 15, I'd say, to 1,600 points once all of this is done. So, again, I'd encourage you, just honest technical analysis here, to have a look into that analysis class. Again, I've been walking people through this, and essentially what I've done is I've asked them for 2 months of patience to let this just clarify just in this location here. And I ask the same of you as well. And if you've got a bullish standpoint on the market, that's fantastic. I respect that. But at the same time, like you would say to me, just be very careful in your approach to the markets. I mean, think through the positions that you're taking. And now is not the time to be blindly jumping into equity prices thinking that we're returning anywhere near to the prices that we were seeing, right, back in January and February of 2020. My opinion, this is the best price that we are going to see at these levels on the equity markets for a number of years into the future. I don't say that lightly, nor have I really ever said this publicly in YouTube before, but now's the time. Some will do, some won't. That's fine. But it's here anyway for those who are willing to listen and who want to listen as well. It's obviously more to the analysis than what I've just run through, but I just wanted to make the point that it's psychology driving this. It's exactly what is intended during that of a bear market rally. And I hope, right, you're not under its wand at this particular point. Okay, so anyway, I'll leave it at that for this Saturday recap. Be safe, obviously, and don't do anything silly out there in the equity markets at this particular point. Now's not the time to be putting risk on. All right, everyone, enjoy your weekend. I'll be back with you during the week for some more market updates. All the best. It's James signing off on behalf of Pivot Point Trading. Bye-bye.